Hi everyone, in this video we are going to discuss about an important topic in financial management, that is leverage. The concept of leverage and its various types are discussing through this video. So let's move on to the topic. Leverage. In financial management, the term leverage is used to describe the ability of a firm to use fixed cost assets or funds to magnify the return to its owners. Okay, to know more about leverage, we can think about an example. Just imagine that you want to lift a car. Just imagine what kind of pressure or force you have to give for lifting that car. Okay, for this purpose, you can use a small tool called lever. If you use that tool called lever, then you need to apply only a lesser amount of force from your side. That means that tool will help you to lift the car with less effort from your side. That means you are giving little amount of pressure and that pressure get magnified into a wider force and that helping you to lifting that car with a less effort. This same concept is applied in the case of a leverage. In this case, fixed cost funds like debentures, bonds, loans, or fixed cost assets like building, machinery, etc., can be used as a lever to magnify the return to its owners of a business. The owners include the equity shareholders. There are three types of leverage. That they are financial leverage, operating leverage, and composite leverage. The composite leverage is also called combined leverage. Let's discuss about various types of leverage. First one is financial leverage. Financial leverage is also called trading on equity. Financial leverage is defined as a firm's ability to use fixed financial charges to magnify the effect of changes in EBIT. EBIT is earning before interest and tax on the firm's EPS. EPS is earning per share. That is, in a business, you can run your business by employing all your money. That means only with your money. Or in your business, you can invest small portion of money and bring the sizable portion of money from the outside. And that way you can run your business. The benefit from the second case is that you are applying or using only small amount of money from your side and sizable portion comes from outside. So what happens from this is when the business make profit after paying return to outside funds, whatever remains in the business is go to the pocket of owners, that is you. So there you are going to make a disproportionate return because your contribution is less but outside contribution is more. When making profit, a fixed return is paid to the outsiders for their contribution and whatever left in the business is yours. By concluding, we can say that the long term fixed interest bearing debt, like debentures, bonds, or long term loans, is employed by a firm to earn more from the use of these resources than their cost so as to increase a return on owner's equity or owner's fund. Degree of financial leverage. The degree of financial leverage measures the impact of a change in operating income on change in earnings on equity shares. Operating income is earning before interest and tax. The degree of financial leverage can be calculated using a formula, that is, degree of financial leverage is equal to the percentage change in EPS. EPS is earning per share divided by percentage change in EBIT, earning before interest and tax. Or it can be calculated using another formula, that is EBIT divided by EBIT minus I. EBIT means earning before interest and tax. I is interest. The second type of leverage is operating leverage. Operating leverage results from the presence of fixed cost which helps in magnifying the net operating income. Fixed cost include cost of acquiring fixed assets like machinery, building, etc. Fixed cost remaining the same, the percentage change in operating income will be more than the percentage changes in sales, this occurrence is known as operating leverage. This means the changes in sales are related to changes in revenue. The fixed cost does not change with the change in sales, it is always constant. Any increase in sales will increase the operating revenue. The operating leverage occurs when a firm has fixed cost which must be recovered respective of the sales volume. Let's look into an example of operating leverage. In this example, we can see that there is two statements. These two statements shows the change in operating profit and percentage change in operating profit and percentage change in operating sales. In the first statement, there is no fixed cost, or there is no fixed cost content, or there is no leverage. There is a sale and a variable cost. Sale minus variable cost is profit for profit. In the first case, the percentage change in sales is 25%, and the second case, percentage change in operating profit is 25%. Okay. In the second case, there is fixed cost content, or there is a leverage. Okay. Sales minus variable cost is contribution, and contribution minus fixed cost is operating profit. In the second case, the sales percentage change in sales is 25%, and a percentage change in operating profit is 100%. From this illustration, we can say that we can conclude that if there is no fixed cost, the percentage change in sales and percentage change in operating profit are same. That is reviewed from the first example, that is 25%. Sales percentage change in sales is 25%, and percentage change in profit is 25%. When there is a fixed cost, there is leverage, and the percentage change in operating profit is 100%, is more than the percentage change in sales. This is revealed through the second statement. Okay. This is about how operating leverage works. Leverage can be calculated using a formula, that is contribution divided by operating profit. Operating profit is earning before interest and tax. Contribution is equal to sales minus variable cost. Variable cost is deducted from sales to get the contribution, and sales, variable cost and fixed cost is deducted from sales to get the operating profit. Degree of operating leverage. Degree of operating leverage measures the impact of changes in profit on changes in sales. So, the operating leverage can be calculated. Degree of operating leverage can be calculated using a formula, that is percentage change in profit divided by percentage change in sales. This is a formula to identify the degree of operating leverage. We are discussing about the types of leverage. Already we discussed financial leverage and operating leverage. Now we are moving on to the composite leverage. Composite leverage is also called overall leverage or combined leverage. It's a combination of operating leverage and financial leverage. It depicts the relation between the sales and taxable income. And it helps in finding out the resulting percentage change in taxable income on account of percentage change in sales. That means it combines, or it depicts a relation between the changes in sale and changes in taxable income. Okay, so this is about composite leverage. Combined leverage is equal to operating leverage into financial leverage. That is, it is a combination of, combined leverage is a combination of operating leverage and financial leverage. So we can calculate the combined leverage using this formula, and degree of composite leverage is equal to percentage change in earning per share divided by percentage change in sales. In this video, we discussed about the concept of leverage. That is, the leverage is used to describe the firm's ability to use fixed cost assets or funds to increase the return to its owners. And the various types of leverage, they are financial leverage, operating leverage, and combined leverage. Okay, hope you all understood what I discussed in this topic, and thank you for watching this video.